Conversation that's lined up. Sapna's in conversation with Mr. Pandey, the DIPAM secretary. So let's cut across to that conversation. Sapna?
In conversation with the DIPAM and Finance Secretary, Mr. Tuhin Kanta Pandey. He wears many hats. He's also additionally in charge of DPE, that is Department of Public Enterprises, as well as DOPT. For today, as of now, thank you so much for joining us, sir, giving us time once again. Just wanted to check up with you, sir, on the latest CPSE capital restructuring guidelines which have come out. What is the intent of the government, and is it correct that this review, the basic template, has actually been revised after 8 long years?
Yes, I think it's basically an update after the experience of 8 years, taking into board the new realities, the new valuation systems which have emerged in case of PSE, CPSEs. Also the fact that we had issued certain interim advisories which have also been consolidated, plus providing, the objective of our main objective of providing operational and financial flexibility while giving, due returns to the minority shareholders. Okay.
So now, if I look at it from the point of view of dividend payouts, for instance, some relaxation is visible there, against the 5% net worth, it's now 4%, a tad lower than the earlier regime, and also you have done away with the net worth criterion for CPSE, NBFCs. So that's one aspect. You can elaborate on that, sir. But apart from this, have some of the conditions been tightened, quote unquote, as far as your stock split, share buyback and bonus shares are concerned? Could you clarify?
Let me come to the dividend part. Dividend is basically the minimum guidelines, not the ones which they would be capable of giving. The boards are independent and they may give more than that as well. In some cases, even the minimum guidelines they may not be able to fulfill. But there, we have a system of, granting exemptions to them on their request. In the minimum guidelines, there were 2 conditions. One was the net worth, another was the payout of the profit. So you have 30% of the profit, PAT.
That remains unchanged.
That remains the same. The other condition, was that there were 2 conditions, whichever was higher, 30% of PAT or 5% of net worth, whichever was higher. We have made it 4% of net worth instead of 5%. And the reason is that some of the CPSEs do have their own business plans in terms of capex, in terms of growth, where in their net worth condition sometimes creates a problem. So we have made it clear that, in that case, we will slightly relax it to enable them, sort of more resources for their internal generation so that they would be able to pull into for their growth. The other part was in this case of CPSCs, which are NBFCs, in the nature of NBFCs.
To name a few, sir?
For example, PFC is there, REC is there, IREDA, IRFC is there, HUDCO is there. In these CPSCs, capital is basically the raw material. They don't manufacture. They are basically capital. Their net worth is used to again raise more money and also lend. Now, net worth is important in terms of capital adequacy and other regulatory requirements. So therefore, essentially they are high net worth companies, and if you have a percentage of net worth also as an added condition, and we are saying whichever is higher, sometimes we would be asking them to give more dividend than what is necessary, and rather their money capital could also be used to lend more. So in any case, that also is advances our objective of giving them operational and financial flexibility.
Okay, all right. We'll keep cutting back to Sapna's and when we get some important soundbites on some of the crucial, pending divestments as well. But let's take stock of the market. As Prashant mentioned, it's a good trading session, though we have come off a little bit from the top. And it had the ingredients of being a good trading session.